Let me also bring in Peter McGuire, Chief Executive Officer at XM Australia. Peter, good morning. How are you doing? And, we're tracking a whole host of, factors right now, Peter, but since we're just on the topic, let me get your view as well on some of those trends that we've observed in gold versus silver. What do you see going forward? Do you expect to see that rebound in gold? How are the precious metals looking to you?
Well, good morning, and greetings from Dubai. I think a couple of things. First off, yes, you're putting your mind back to 1990, 1991, that ratio. Uh, what happens over the next matter of days, and where does the next couple of months take us as far as US possibly dropping interest rates, Bank of Japan meeting, of course, BOE as well this week. So we've got major moving parts that are going to, I think, probably push gold higher from here. I wouldn't be surprised to take a 1375 as your next sort of level up, and silver will go along for the ride as well. And when you see that ratio, you probably think from any trader's perspective, there's certainly far more upside for possibly silver than gold in the short to medium term. So it possibly is going to be a one hell of a trade.
It seems to be, Peter, but how much more upside do you see in the more longer term? Or do you feel that this is a knee-jerk reaction because, a lot of heightened talk and hype around whether the US yields are indicating that US is headed in for a recession, all this heightened trade war threat as well between US and China? Do you think it's all that also which is sentimentally leading to this uptick in the precious metals? What I'm trying to ask is, how sustainable is this move in gold?
Well, I think the rally has been quite robust over the last matter of months, and a couple of reasons why. With that structural weakness globally, you've only got to look at those sort of numbers coming out from the Eurozone and, of course, China, and that's just the first start of it. Though we've got fairly strong markets in the sense of the US equity market, we're still saying that this year you could see 2 rate cuts, if not 3. So that's not a good sign for, it demonstrates structural weakness. And the other side, of course, is that will drive, I think, gold higher from here. So as you ratchet down interest rates, traders look for other opportunities, and naturally you've got inflation under control. So I think that's going to push, the price of gold higher. So that seems to be, I think, a no-brainer as far as the trade concerned. And then the next thing is, what other markets is it going to lift? So I think that from a opportunity standpoint, it's not a bad place to be across some of those precious metals.
Interesting. What's your overall outlook also, Peter, on the commodity front in light of the trade tensions specifically? If we do see an unraveling of that situation, what's the kind of fallout you expect?
Well, I can't see anything to really drive crude higher from here in the short term. We demonstrated that last week. The market went up 4% when those strikes on those 2 tankers in the Gulf of Oman near the Strait of Hormuz. And then, later in that trading session, it gave up 2% of those losses. So, or 2%, of the gain. So there's nothing there to really push it higher unless you see something dramatic happen on a geopolitical front, and that would have to be, those Iranian, possibly the, more attacks on ships. So if you take on board that, I really don't see a lot of upside there for the crude market. We're oversupplied. From a demand picture, it seems to be, moving downwards. In the sense of the forecasters and their analysis over the coming months. If you look at OPEC, you look at the IEA and the EIA, so all of them are, synchronicity as far as their viewpoint. And I think that the commodity side will probably be a little bit fragile leading into, the latter part of 19 and early 20.
Okay, let's talk about the Fed now, Peter. You mentioned earlier as well, you touched upon it, the markets are eyeing what comes out of that meet. It's interesting because while at some level a cut is factored in, possibility of it not coming through this time is also high. Markets have anticipated that they might change their commentary but shift the actual cut a little down the line. What's your sense? And also, while there have been growing calls for that cut, do you really feel it's going to have a significant impact on in terms of working as a stimulus at this point?
Well, I think it probably will stimulus. It'll give it some courage and of course, confidence to the market. And then the next part, of course, is, there's I think most analysts are saying there's a 20% chance of it happening at this meeting. So I'm probably saying it's going to be July or August. That seems to be the natural thread there. And, another one later in the year, and you may get another one after that. So there are so many factors at play, and I think one of the largest things that hasn't been put to bed, as everyone knows, is the China-US trade talk. So what happens there? Is there a deal done at the G20 in Osaka later in the month? This month is the next 2 weeks are really very interesting for global markets, as you mentioned, as far as Fed, Bank of England, BOJ, a number of the other banks coming on, as far as their announcements. Then you've got OPEC next week in Vienna. Then you've got, the latter part of the week as well, Osaka and the G20. So really, there are so many contributing factors and actors going into the market. You may see, a further decline as far as some of those currencies and some of those, interest rate forecasts. So that really is the general consensus at the moment, and it's very much a wait and see process.
And you forgot Draghi, Peter. We're also waiting to see what he says. Talking about stimulus, what about China? Do you feel that we could possibly see some more ammunition, some more stimulus measures, something coming out of there, particularly in light of the trade wars?
Well, I think they've got to go down. Definitely, it seems to be work in progress. We'll keep a close eye on what's happening, and it's very much a process. And like it or not, China needs to have a growth engine behind its whole economy. We're very conscious as far as the numbers, and we've got that, the unknown with the trade talk. So that's creating its own moving parts, which in turn is confusion. And that's, I think many traders and governments are looking for some sort of action to take place, and be there a deal or no deal. And I feel as though that as each month wears on, China is going to be positioned to actually have to maintain its growth, and of course stimulus is going to be the natural measure to create that necessary market confidence for the Chinese sector.
Peter, according to you, and just as we wind up, but what would be the biggest pain point right now? Would it be slowing growth in the US? Would it be China on the back of the trade tensions? What will you be watching most closely now moving forward? What according to you could be the biggest potential upset going ahead?
I think it's got to be a combination of a number of factors. Yes, certainly is trade as far as China growth numbers include, and where does the Fed position itself? And the Fed ratchets down a couple of moves as far as rate cuts, then in short succession, then that's, I think, going to have a dramatic effect to a lot of the global currencies. And what happens as far as you mentioned, as far as Draghi, we've got he's on his last legs as far as his tenure there at the ECB. So it's again, so many different components going into the market at the moment, and confidence is what everyone's after. And it might be a very interesting end of 2019. The last 6 months could have some significant volatility swings.
Peter, thanks so much for joining us this morning. Good to have you with us as always, and have a good day ahead in Dubai.